They stole your silver. That is not a metaphor. That is not clickbait. That is the only accurate description of what happened. Over the last 24 hours, the silver market did not simply move. It was engineered. If you were watching the charts yesterday, you didn't just see red candles. You saw fear. You saw panic. You saw headlines screaming that the bull market was over, an 8% crash. In a single session, social media exploded, comment sections turned toxic, analysts suddenly changed their outlook. Weak hands folded, stops were hit, margin calls rang like alarm bells, and somewhere in that chaos, millions of ounces of silver changed hands. Not because of fundamentals, not because of supply, not because of demand, but because of a trap. This was not a market correction. Let's get something clear right now. What you witnessed was not a healthy pullback. It was not price discovery, and it was definitely not a random sell-off. This was a calculated algorithmic flush, a move designed to do one thing, and one thing only: separate you from your position. This is how modern markets work. They don't hunt prices, they hunt liquidity. And where is liquidity? Below the market, at obvious levels, at round numbers, at stop-loss clusters. And yesterday, silver was sitting on a gold mine of stops. The perfect setup. For weeks, silver had been grinding higher. Momentum was strong, retail confidence was high, leverage was building quietly in the background. Everyone could see the same chart. Everyone saw the same support zone. Everyone placed stops in the same area, around $72. That wasn't a coincidence, that was a target. Institutions knew it, banks knew it, algorithms knew it, and when the time was right, they pulled the trigger. The flush price slammed lower, fast, violent, relentless. Stops began to trigger one after another. Margin traders were forced out. Sell orders cascaded. And here's the part most people don't understand. The selling wasn't organic. It was forced. Weak hands didn't choose to sell. They were made to sell. That's how traps work. Fear is a weapon. Markets are not driven by logic in moments like this. They are driven by emotion. Fear compresses time. Fear shortens thinking. Fear makes bad decisions feel necessary. People didn't sell because silver was done. They sold because the pain became unbearable, and that pain was intentional, because panic creates opportunity for those on the other side of the trade. Then, the reversal. And just like that, the engines reversed. No warning, no headlines, no mercy. Silver snapped higher, aggressively, violently. It was 335s in a single session. A 5% move that erased nearly half of the entire crash. And suddenly, the same people who panicked yesterday were staring at the screen in disbelief today. Silver trading at $74, $54. The market didn't collapse. It exposed you. This is how the game is played. This is not new. This is not rare. This is not accidental. This is how liquidity is harvested at scale. Institutions don't chase price. They manufacture opportunity. They push price where it hurts the most, where retail is the weakest, where leverage is highest. And when the trap snaps shut, they buy everything you were forced to sell. The psychology of weak hands. Let's talk about weak hands. Not as an insult, but but as a state of mind. Weak hands are not stupid people. They are emotional participants. They trade with fear. They trade with hope. They trade with leverage they can't afford. And markets are designed to exploit that. Yesterday, when silver dipped toward $71, the psychology shifted instantly. This is it. The bull run is over. I should just get out. That's not analysis. That's capitulation. And capitulation is fuel. Strong hands move in silence. While panic was spreading, strong hands were not tweeting. They were not posting charts. They were not screaming targets. They were accumulating quietly, systematically, at prices retail begged for weeks earlier. This is the brutal irony of markets. You sell where you should buy. You buy where you should sell, unless you understand the trap. This was a bear trap, not the end. Yesterday's move had a name, a bear trap. A false breakdown designed to convince you the trend has ended right before it continues. And the speed of today's recovery proves it. Real crashes don't bounce like this. Real tops don't reverse in hours. But liquidity events do. Why this matters going forward. Because this was not just about yesterday. This was positioning for what comes next. End-of-year flows, institutional window dressing, portfolio rebalancing, capital rotation. The final days of the year are not quiet, they are strategic. And silver just sent a message. If you're still holding, if you didn't panic sell, if you didn't smash the sell button, if you survived the flush, you are not the victim. You are the survivor. And in markets, survival is everything. Now, here's where things get really interesting. Because to understand the violence of today's move, You need to understand what happened over the weekend, how psychology built the trap, and why this move may have just unlocked the buying opportunity of the year. That's where the real story begins. The weekend that built the trap. The most important part of this move did not happen during market hours. It happened in silence. It happened when charts were closed, volume was thin, and attention was elsewhere. It happened over the weekend. This is where most retail traders stop watching. This is exactly where institutions start planning. Markets don't sleep, they reset. When markets close on Friday, price pauses, but positioning does not. Risk desks reassess exposure. Funds rebalance probability. Algorithms recalibrate thresholds. By the time Sunday night arrives, the move is already mapped. Retail thinks in candles. Institutions think in scenarios. And the weekend creates the most dangerous scenario of all, asymmetrical information, the illusion of safety. Going into the weekend, silver looked stable. Support had held multiple times. Momentum traders felt comfortable. Stops were placed safely below obvious levels. This sense of safety was the foundation of the trap. Because safety breeds complacency, and complacency concentrates risk. When everyone agrees on where support is, support becomes a target. Liquidity does not appear randomly. Liquidity is not volume. Liquidity is forced action. A stop-loss order is not protection. It is a promise to sell at the worst possible moment. When thousands of those promises stack at the same price, they form a liquidity pool. And liquidity pools are magnets. Institutions do not ask where price should go. They ask where orders are sitting. Over the weekend, one thing became clear. Below $72, there was size. The role of thin markets. Sunday open is not a normal market. Liquidity is thinner. Order books are fragile. Small pressure creates large movement. This is not a flaw, it is a feature. A relatively small push in a thin market can trigger a chain reaction. Once the first stops are hit, the rest follow automatically. This is how a controlled move becomes a violent one, the first crack. When silver slipped below support, it didn't collapse immediately. It hesitated. That hesitation was critical, because hesitation creates doubt, and doubt invites fear. Traders told themselves it was temporary. They watched, they waited, and then price accelerated. That acceleration was not panic selling. It was mechanical selling. Stops triggering stops. Margin calls forcing liquidation. Algorithms responding to volatility. The market was no longer being traded by humans. Why the drop felt personal. The decline was fast enough to shock, but slow enough to be felt. This is intentional. A flash crash recovers too quickly to hurt. A grind lower exhausts patience. This move sat in between. It gave traders just enough time to feel regret. Just enough time to feel trapped. Just enough time to act emotionally. And that emotion is what liquidity looks like. The narrative shift. As price dropped, the story changed. Suddenly, the same data meant something else. The same headlines were reinterpreted. The same analysts found new reasons. This move makes sense. This was overdue. This confirms the top. Narratives do not lead price. They follow it. And once the narrative flips bearish, the trap tightens. Capitulation is not a choice. At the lows, selling is rarely voluntary. It is forced by margin requirements, forced by risk limits, forced by fear of total loss. By the time most people sell, the damage is already done. And that is precisely when accumulation begins. The other side of the trade. Every forced seller has a buyer, but that buyer is not emotional. That buyer is not reacting. That buyer is executing a plan built days earlier. Accumulation does not happen at highs. It happens when selling is unavoidable. The more desperate the selling, the better the fill. This is why the bounce was violent, why the reversal was immediate. When selling pressure is artificial, it ends abruptly. Once stops are cleared, once weak hands are flushed. Once margin sellers are gone, there is no one left to sell. Price does not drift higher, it snaps. The speed of the recovery is the signature of a trap. What a real breakdown looks like. Real breakdowns do not bounce 5% in a session. They grind lower. They retest, they fail again, they trap buyers. This move trapped sellers. That distinction changes everything. The institutional clock. Timing matters. This move occurred at the end of the year for a reason. Funds adjust exposure before reporting periods. Profits are locked. Positions are cleaned. Selling into year-end weakness is common. Buying after forced liquidation is strategic. Silver provided both. On schedule. Window dressing and reality institutions care about how portfolios look, not just how they perform. Strong assets are strengthened. Weak hands are removed. Silver's flush removed noise. The recovery restored structure. From a portfolio perspective, the trade is cleaner now than it was before the drop. The trap was the test. This move was not about price. It was about conviction. Who understands the market? Who trades narratives? Who trades emotion? The market tested resolve and took inventory. Those who failed provided liquidity. Those who passed remained positioned. Why this changes the outlook. After a flush like this, the market resets. Leverage is reduced. Stops are cleared. Fear has already been spent. This is not a weak condition. It is a strengthened one. Volatility that removes weak hands builds stronger trends. The most dangerous assumption. The most dangerous belief after a move like this is that it is over. Traps are not endpoints. They are transitions. They move assets from impatient holders to patient ones. And once that transfer is complete, price behaves differently. What comes after? The trap. After liquidity is harvested, markets seek efficiency. That efficiency often appears as trend continuation, not immediately, not recklessly, but deliberately. And those who are shaken out are forced to watch from the sidelines. The market has memory traders. Remember pain longer than logic. Those who sold will hesitate to re-enter. Those who survived will protect their position. This imbalance affects price behavior. Supply tightens, demand becomes more aggressive. The aftermath of a trap is rarely quiet. Understanding this changes everything. Once you see how this works, price stops feeling random. Moves become structured. Fear becomes a signal. Volatility becomes information. The market did not betray you. It revealed itself. This is where the mechanics end and the implications begin, because what happened here sets the stage for what happens next. And to understand that, we need to look at positioning, flows, and why this recovery may not be the end of the move, but the beginning of something much larger. After the flush, what the market is really signaling. When the panic is over, the real story begins. Markets are loud during crashes, but they are honest during recoveries. And the recovery in silver was not subtle, it was decisive. This is where most people get it wrong. They think the danger is behind them. In reality, the information is just starting to surface, because post-flush behavior tells you far more than the flush itself. Price action is language. Markets speak in movement, not headlines. A sharp decline followed by a violent recovery is not noise. It is a statement. It says selling pressure was exhausted. It says supply was absorbed. It says someone with size stepped in and did not hesitate. This kind of recovery does not come from retail buyers. Retail reacts slowly. Retail waits for confirmation. This recovery came before confirmation existed. Who buys into fear? There are only two types of buyers during panic: those who are forced to buy because of hedging requirements, and those who planned to buy long before fear appeared. Neither group waits for reassurance. They buy because the condition they were waiting for has arrived. The flush was not a surprise to them. It was a trigger. The difference between support and acceptance. Support is where price pauses. Acceptance is where price stays. Silver did not just bounce, it reclaimed territory aggressively. That matters, because false recoveries fail quickly. They stall, they retrace, they invite selling again. This move did not ask permission. Volume tells the truth. During the sell-off, volume expanded. During the recovery, volume expanded again. That combination is critical. High volume on the way down shows forced participation. High volume on the way up shows committed participation. This is not short covering alone. Short covering is sharp but brief. This was sustained buying. Short squeeze versus structural buying. Many will label this move a short squeeze. That is an oversimplification. Short squeezes are reactive. They punish late sellers. Structural buying is proactive. It establishes new positioning. The difference is duration. Short squeezes fade. Structural moves build. The behavior following this recovery suggests structure, not chaos. The reset of risk. Before the flush, risk was concentrated. After the flush, risk was redistributed. This is healthy for trend continuation. Leverage was reduced, stops were removed, positions were cleaned. The market is now less fragile than it was before the drop. That is not bearish, that is constructive. Why fear had to be spent. Fear is not infinite. It accumulates and then releases. When fear is spent in a single violent move, it leaves less fuel for future declines. That does not mean price only goes up. It means downside becomes more difficult. The easy sellers are gone. The role of regret. After sharp recoveries, regret replaces fear. Those who sold feel trapped again, but this time outside the market. They hesitate to re-enter. They wait for pullbacks that may not come. This creates a vacuum. When price rises into regret, resistance weakens. Market memory and behavior. Markets remember where pain occurred. The 71 to $70 zone is no longer just a price level. It is a psychological boundary. Those who sold there will hesitate to sell again. Those who bought there will defend it. This changes the character of future pullbacks, the illusion of back to normal. After volatility, people want normalcy. They expect slow movement. They expect consolidation. But post-trap environments are rarely calm. Energy has been released, not eliminated. The market does not go back to sleep. It repositions. Why this move was so fast? Speed matters. Slow moves invite debate. Fast moves force decisions. This recovery forced participants to react without comfort. That is a sign of control. Controlled markets move with intention. What the charts are showing now. Higher lows after violent reversals are not random. They suggest absorption. Each dip is met with quicker buying. Each rally holds more ground. This stair-step behavior is accumulation in motion. It does not look dramatic. It looks persistent. The misinterpretation of volatility. Volatility is often mistaken for weakness. In reality, volatility is transition. Assets move violently when ownership changes hands. Calm markets are owned by the same participants. Violent markets are being redistributed. Silver just changed hands. Why institutions prefer chaos. Order attracts competition. Chaos hides intention. Large players do not want to build positions in quiet markets. They want movement. Movement provides cover. The flush created the cover. The recovery executed the transfer. The end-of-year factor timing is not accidental. Year-end periods amplify moves because liquidity is thinner and positioning matters more. Decisions made here affect reported performance. They affect allocations going forward. Silver was not ignored. It was prioritized. The bigger picture. This move did not invalidate the broader structure. It reinforced it. Corrections within strong trends are violent because they must remove conviction before continuation. This was not distribution. Distribution is slow. This was cleansing. Why weak hands? Rarely re-enter. Correctly, those who sold are now looking for certainty. They want confirmation. They want validation. Markets do not reward that behavior. By the time certainty appears, price has moved. The trap's lasting effect. The trap did not end when price recovered. It continues psychologically. Fear turned into hesitation. Hesitation limits selling pressure. That asymmetry favors continuation. What this says about demand does not announce itself. It appears when supply is forced. The speed and depth of buying during the recovery suggest demand was waiting, not chasing. That is critical. Chasing demand is fragile. Waiting demand is durable. The path forward is not straight. No market moves in a straight line. There will be pauses. There will be pullbacks. But the character has changed. Pullbacks are now tests, not collapses. Why this was a statement. Move markets, send messages. This message was clear. Selling pressure can be created. Buying pressure was real. That imbalance defines direction. The most important takeaway. The market did not reward panic. It rewarded patience. It did not reward prediction. It rewarded preparation. And it did not collapse when fear peaked. It reversed. What comes next requires understanding. From here, the market will look deceptively ordinary. That is where mistakes happen. Because ordinary behavior after extraordinary moves often precedes continuation. To understand what may come next, we need to look at positioning, liquidity paths ahead, and why this move may have cleared the way for something much larger than a rebound. That requires stepping back and looking beyond the chart. The anatomy of the V-shaped recovery, what this means going forward. Markets are not random. They do not move by chance, and the recovery we have seen in silver is proof of deliberate orchestration. This is the final piece of the puzzle. To understand what happened, why it happened, and what it implies for the future, we must dissect the anatomy of this V-shaped recovery. Step 1. The flush was strategic. The initial drop was not about panic. It was about execution. Every decline is scrutinized by algorithms and trading desks. Every level, every stop, every cluster of orders is evaluated. When the decision to push silver down was made, it was made with full knowledge of the market's weakest points. This was precision targeting, not random volatility. Weak hands were removed, liquidity was concentrated, and the path was cleared for the next move. Step 2. Liquidity. Harvesting. Liquidity is the currency of large institutions. They do not buy blindly. They do not sell blindly. They collect where liquidity is richest. Yesterday, the liquidity was in the forced sellers. Retail investors with leveraged positions were flushed out. Stops triggered. Margin calls forced sales. All of it funneled into a pool. The result? Silver changed hands from impatient to patient participants, from weak hands to strong hands. This is how markets operate at scale. Step 3. The recovery was engineered. Once liquidity was harvested, the reversal began. This was not a slow recovery. It was not tentative. It was immediate, decisive, and structured. Palm 335 in a single session. Nearly 50% of the crash erased in the blink of an eye. The speed of the recovery is significant. It shows control. It shows intent. It shows that the market was ready to absorb and reverse the forced selling. Step 4. Psychological shifts. Markets are emotional. The initial flush created fear. Panic ruled logic. Weak hands exited. But as the recovery took hold, psychology shifted dramatically. Those who sold experienced regret. Those who held gained confidence. Those who were waiting saw opportunity. This is the subtle power of a V-shaped recovery. It simultaneously removes fear and strengthens conviction. Step 5. Market structure. Reset. After such a move, the structure of the market changes. Stops are cleared. Weak hands are gone. Price levels previously significant now serve a different role. $71, $72, once a zone of massive risk, is now absorbed. New support levels form. Resistance levels shift. The market has redefined its own landscape. Step 6. Institutional strategy. This move highlights how large players think. Institutions do not act randomly. They operate with foresight. They manipulate liquidity, observe psychology, and execute plans. Yesterday's crash and today's recovery were two halves of a single strategy. Force selling where leverage is highest. Absorb positions efficiently. Reverse to reclaim and consolidate strength. It is simple in concept, but devastating in effect for those unprepared. Step 7. The role of timing. End-of-year flows amplified the impact. Portfolios are rebalanced. Reports are finalized. Funds adjust exposure for new allocations. This is not the first time year-end timing has created volatility, and it will not be the last. The timing was intentional. The move was scheduled. Weak hands were targeted, and those who were attentive profited. Those who reacted emotionally lost. Step 8. Why recovery was violent. Violent recoveries are not mistakes. They serve a purpose. They restore confidence. They demonstrate control. They shift ownership to those who can hold. If recovery is slow, weak hands may re-enter and dilute the process. A fast recovery solidifies positioning. Silver AS 5% jump in a single session did more than erase losses. It reset the market, S psychology. Step 9. The importance of holding. Those who held through the flush are now in a dominant position. Market psychology favors patience. Forced sellers are gone. The remaining holders control liquidity. This is a critical lesson. Survival often matters more than timing. Markets reward those who withstand engineered chaos, not those who react impulsively. Step 10. Understanding supply and demand dynamics. The recovery was not a speculative anomaly. It was a direct reflection of supply and demand in the market. Forced selling removed excess supply. Strategic buying absorbed it. Now the market is leaner, stronger, and ready for continuation. Step 11. The illusion of randomness. To the untrained eye, yesterday's crash and today's recovery appear chaotic. In reality, it is highly structured. Algorithms executed pre-planned scenarios. Institutional desks coordinated flows. Retail participants acted predictably, and predictability was exploited. This is how markets maintain efficiency at scale. Step 12. Lessons from the V-shaped recovery. Panic is predictable. Forced selling creates opportunity. Recovery is deliberate and informative. Survival is more profitable than reaction. Market structure resets during engineered moves. Psychology is as important as fundamentals. Timing magnifies impact. These lessons are universal, not anecdotal. They apply to every market, every asset class, every liquidity event. Step 13. Preparing for what comes next. Now that the flush is complete and the market has recovered, the next phase is strategic positioning. Markets rarely remain static after such events. Participants who survived the trap are now planning the next moves. Positions have shifted. Stops have been cleared. Liquidity has been realigned. The path forward will test conviction again, but in a stronger, cleaner market. Step 14. Why this is not the end. Many will interpret the recovery as a final move. They will expect consolidation. They will expect the market to pause. Do not be deceived. Structural moves rarely end at the first recovery. They set the stage for continuation. They align the players who can influence price. They remove those who cannot. Step 15. The strategic implications. Understanding this event requires stepping back. Who controls liquidity? Who was forced to sell? Who absorbed the supply? How did psychology affect behavior? What does the speed of the recovery indicate about intent? Answer these questions, and you understand the market. Ignore them, and you remain reactive. Step 16. Market memory and momentum. Markets remember pain. They react differently in areas of past liquidity flushes. Hesitant sellers and emboldened holders create asymmetric conditions. Momentum now favors those with conviction. Those without resolve will struggle to re-enter. This is how trends are born. This is how opportunities are built. Step 17. The broader implications. Beyond silver, this event provides insight into modern markets. Liquidity is targeted, not incidental. Emotional reactions create predictability. Algorithms and institutions exploit structure. Survival is rewarded more than intuition. Recoveries can be more informative than crashes. Understanding these dynamics provides a blueprint for navigating volatility. Step 18. The takeaway. Yesterday's flush was brutal. Today's recovery was decisive, but the message is clear. Panic can be engineered. Recovery can be orchestrated. Positioning determines the victor. Those who were prepared were rewarded. Those who reacted emotionally were not. This is not opinion. It is market mechanics. Step 19. Conclusion. Markets are not chaotic. They are calculated. They are emotional. They are strategic. This V-shaped recovery did more than restore price. It redistributed positions. It reset psychology. It revealed the structure beneath the volatility. The lessons are clear. Expect engineered moves. Recognize the patterns. Position for resilience. Respect the psychology. Patience is profitable. And above all, understand that volatility is not the enemy. It is the signal.